Good day, class. This is the recording for the third week of lectures for topic 2. We've handled the time value of money section, and now we're going to move on to valuations. So we're going to use the principles that we learned in the previous 2 weeks of lectures to apply to valuations. Just note that some of today's lecture, this week's lecture, which is all about bonds, is contained towards the end of chapter 2 of your textbook. I referred to it at the time, so you can please go back there and refer to that short section on valuing bonds, which is included in the session today, and there's chapter 6 in your textbook. Okay, so I'm going to share my screen for the slides. There we go. So, as I said, we're moving on to chapter 6 of our textbook, which is all about valuations. At the end of this chapter, I would like you to be able to outline the concepts that are applied in the valuation of assets, understand the effects of risk and return on valuations, learn more about interest rates and required returns, and then value debentures, which is another word for bonds. So the bullet points outlined in blue are for today's session, and those outlined in red will be for next week. So next week we'll be learning how to value preference shares using the constant dividend growth model to value ordinary shares, also applying a two-stage valuation dividend model to value ordinary shares in other circumstances, using the discounted cash flow or free cash flow model to value a company and the ordinary equity of a company. And then we'll briefly mention using other valuation methods such as the PE ratio and the earnings before interest, tax, and depreciation multiples to value ordinary shares, as well as using the EVA approach to value the ordinary equity of a firm. Then just tying up with how valuations affect the role of the financial manager and how we need to make an adjustment to valuations in the case where there's a lack of marketability of the asset concerned. So what are valuations? We're going to tackle some valuation myths. We'll look at the effect of risk and return, the relationship on value, interest rates and bond or debenture valuation, both factors that affect interest rates, and then we'll learn how to value redeemable debentures, which are debentures with a fixed maturity date, and debentures in perpetuity, which are non-redeemable. In other words, they don't have a maturity date. And that's for this week. And then next week, as I said, we're going to be valuing preference shares and ordinary shares using different approaches. So what are valuations, firstly? Basically, it's the determination of the value of an asset in monetary terms. Now, the value of any security or asset, we use the approach that it's the present value of the future cash flows emanating from that asset or instrument or security, discounted at an appropriate discount rate that reflects the underlying risk of that investment or security. Now, because the future is uncertain, and therefore the future cash flows that have to be estimated are uncertain, valuations will be subject to uncertainty. And an active market, or investors need an active market to reflect trading prices. For example, the Johannesburg Stock Exchange, which creates prices or values based on the buying and selling interactions of millions of investors And we can value a security based on its expected future cash flows, and then we can compare that value to the listed share price, for example, on the market as reflected in the JSE. So, but basically in corporate finance, the valuation of any asset is determined by its future cash flows. So let's unpack some of those myths first. Now, a myth, for those of you who don't know, is a sort of widely held but false idea or belief about something. So these are falsehoods. These are all incorrect, but they're widely held beliefs. That valuations, firstly, are based, because they're based on quantitative models, then they must always be accurate. But really, just because a valuation is usually based on a fairly complex quantitative formula, it doesn't mean it's 100% accurate. Any model is only as good as the inputs that you provide and the assumptions that you use. So that's not necessarily true. The second myth is that valuations are objective, which of course they're also not, because they'll be influenced by the biases and the needs of the person performing them. So they're definitely not objective. They'll tend to be subjective. Valuations are precise. Well, that's sort of linked to the first myth. Those valuations are really based upon estimates about future cash flows, estimates about the discount rate or the cost of capital to use. So they can't necessarily be precise. That valuations are valid for an extended time period. That's also not true necessarily. Assumptions and estimates are made about the future when you're valuing an asset. And with time, with new information coming in, assumptions might change, and therefore the information or the valuation will change. Sorry. I'm talking about new information coming in about interest rates, the state of the economy. These things change all the time, and those in turn will affect the assumptions behind the valuation, and therefore will affect the valuation. What will change? The final myth is that the number or the figure itself is the most important. But really that's also not true, because the valuation relies on key variables which drive the valuation. So those are equally important. So it's not the final number that's the be all and end all. It's all the variables or the inputs that go into the valuation model that are also important. What are the building blocks of a valuation? So as the valuation of an investment is the present value of the future cash flows, it's going to be affected by factors such as the amount of each cash flow and the timing of these cash flows. Now, both of these have to be estimated, and both are driven by the nature of the investment and the management of the investment. Then there is the riskiness of those future cash flows. And we need a required rate of return. Now, we adjust the required rate of return to account for the riskiness. So the required rate of return will depend upon the riskiness, which in turn depends on the nature of the investment, its sensitivity to economic factors such as inflation changes and interest rate changes, etc. Now, that required rate of return, or sometimes called the discount rate, because we're present valuing all our future cash flows at this rate, is affected by lots of factors, not just risk, also interest rates, for example, as you'll see specifically in the case of bonds, that would be applicable. So how exactly does risk and return affect value? Now, the value of an item is bound to the return it generates and the risk that it carries. So let's illustrate. What is the effect of return on value? If asset A is returning R1 million a year and asset B is returning 1.2 million a year, then if both assets are of a similar risk, then asset B will have a higher value. Okay, so B has the higher return, therefore it will have the higher value as long as the assets are of a similar risk. Let's illustrate the effect of risk on value. If assets C and D are both offering the same return, for example, R1 million a year, but C is more risky than D, then asset D will have a higher value. Okay, because if you are taking more risk as you are in asset C, but you're getting the same return that you're getting from asset D, which has less risk, then obviously asset D will be the preferred investment and have a higher value. So all valuation models are based on the relationship between expected return and risk, which will be reflected in the required return for that particular asset. If the expected return that we receive on an asset based on what it costs us is less than the return that we could get on a similar risk asset, then the asset is not worth what we paid for it. Let's look at values and rates of return. An example, just say an investment costs 10 million and it promises a perpetual return of R1 million every year in perpetuity forever. If the required return is 12%, then the value would be less than 10 million. Why is that? Think about it. If you're paying 10 million for something and it's giving you R1 million a year return, that reflects a 10% return. Do you agree? But if the required return is 12%, then its value is going to have to be less than 10 million. Because the actual return is only 10%, and to offer 12%, then the price must fall to 8.33 million. Remember how we present value at perpetuity? We put the payment or the perpetual amount over the interest rate, the required return. So we would put the 1 million perpetual payment over the interest rate, a required return of 12%. And it will be actually, it will actually be valued at 8.33 million. Okay. So its return is 10%. If similar assets are offering 12%, then it's not worth the 10 million that you originally paid for. It would be worth 8.33 million. So to offer 12%, that's what the price would have to fall for. If you bought it for 8.33 million and you were getting 1 million per year forever, then your return would be 12%, and you can work that out. Okay, so I hope you're seeing the sort of link between the relationship between return, risk, and your required rate of return, your actual return, and risk. So Since the value of an asset is the present value of the future cash flows that emanate from that asset, we need an appropriate discount rate. This will be compensation to the supplier I'm looking for a highlighter, but I don't want to use yellow. Red is always better. Okay, so it will be compensation to the supplier for providing funds to the demander. So the interest rate, which will usually be applied to debt instruments such as bonds, will be compensation by the borrower to the lender. Okay, so the lender of the funds will get this interest or charge this interest rate to the borrower. Required return is the term that will usually be applied to equity instruments such as shares. And that will be compensation by the issue of the shares to the investor in the shares in return for that ownership interest that they're buying. So how do we determine the discount rate or the required rate of return? One way is to look at the return on similar assets that are trading on the financial markets. When we say similar, we mean a similar risk profile, for example. It's not always that easy to identify that, but you can at least try. The required return on ordinary shares, by the way, is called the cost of equity, and that's a term that you'll be becoming more familiar with as you go further into the course. I think it's covered under chapter 7 of your textbook. Sorry, I'm not too sure what happened there. So what factors affect interest rates? So financial markets or institutions and markets create the mechanism whereby funds flow between savers and borrowers. You would have learned about that in topic 1. And remember, savers obviously want to earn as much as possible and borrowers want to pay as little as possible. So the interest rate in the market at any particular point in time will reflect equilibrium between those savers and borrowers, where they sort of reach agreement between each other through supply and demand. A variety of factors influence this equilibrium rate, which will include inflation. Typically, investors or savers will demand a higher return when inflation is high, because obviously they need their investments to outpace rising prices as a result of inflation. So a rising trend in the prices of most goods and services will typically mean that investors or savers will demand higher returns. Risk is another factor. When people perceive that an investment is riskier, by risky, we're saying, there's more uncertainty around will they get their money back or not. Then they're going to expect a higher return to compensate them for taking that higher risk. And then liquidity preference. This is all about all other things being equal. Investors generally prefer to invest in the short term rather than in the long term. So despite the relatively lower return that short-term investments offer relative to long-term investments, they might have a liquidity preference. In other words, they need to be able to get their money out of that investment sooner rather than later. For example, investing in government treasury bills would be a good way of doing that. They're very liquid. You can get your money out quicker. They might have to sacrifice some return for that liquidity preference. We've already touched on this earlier in this particular topic, but I'll bring it up again. We need to talk about inflation. So you've got your nominal interest rate. And that, as we know, is the actual quoted rate charged by the supplier and paid by the demander of funds. And unless mentioned otherwise, interest rates and required rates of return are nominal. They're annual and they're nominal, unless mentioned otherwise. And this rate has not been adjusted for inflation. And we refer to that in the Fisher formula as capital R. Then you've got the real interest rate, which would be the rate that's been adjusted for inflation to reflect the fact that what you can buy with your money has changed. And we refer to that as little r. Now, R is going to differ from big R. Capital R is going to differ from little r as a result of inflation, both inflation and risk. And the Fisher effect can define the relationship between real rates, little r, nominal rates, big R, and the expected inflation rate, which we indicate with a small h, lowercase h. And that's the Fisher effect formula, which says that 1 plus the nominal rate will equal 1 plus the real rate times 1 plus the inflation rate, or put another way, your real rate will equal 1 plus your nominal rate divided by 1 plus your inflation rate, or minus 1. When you've got very low interest and inflation rates and you just want a quick estimate or approximation, your nominal rate will equal your real rate plus your inflation rate. And that approximation, as I said, will work fairly well with normal real rates of interest and expected inflation. But if the expected inflation rate is particularly high, and your nominal or real rates are fairly high as a consequence, there could be a substantial difference in using this approximation formula. So that's the more precise formula, the Fisher effect. Let's go through another example. You had one earlier in your notes, but here's another. So Mavis invests 100 Rand in a fixed deposit for 1 year at a rate of 7%. At the end of the year, obviously, she'll have 107, which is your, let me get a thinner pen going. That'll be, if she invests 100 for 1 year at 7%, I've got to move this screen, 0.07. 100 Rand will have grown by 7% to 107 Rand. Now, if sweets cost her 2.50 Rand at the beginning of the year, with her 100 Rand that she had, she could have purchased 40 sweets, okay? 100 Rand divided by 2.50 Rand. But assuming an inflation rate of 4% over this year, by the end of the year, the sweets could cost her 2.60 Rand. How do we get that? We take the 2.50 Rand that they would cost at the beginning of the year, we inflate it by 4%, so we multiply by 1.04, and that gives us 2.60 being the price of sweets at the end of the year. At the end of the year, with her 107 Rand, how many sweets could she buy at a cost of 2.60? Well, it's 41.15. Okay, I just took the 107 Rand that her investment would have grown to, and I divide by the cost of sweets at year end. She could purchase 41.15 sweets versus the 40 sweets she could have bought at the beginning of the year. And that amounts to only 2.88% more sweets. Okay, how do you get that? You go 41.15 minus the 40 that you could buy originally, over the 40 original cost, and that's where you get your 2.88%. That's the increase in the number of sweets that she can buy versus the 7% straight increase in terms of her 100 Rand invested at the nominal rate of 7%. So without accounting for inflation. Accounting for inflation, the rate is actually only 2.88. So although the return earned on the investment was 7%, the actual return on the number of sweets she could purchase is only 2.88. We could have used Fisher to work out that real rate of return anyway by going 1 plus our nominal rate divided by 1 plus the inflation rate minus 1 to get the 2.88% that we got when we looked at it from how many more sweets she could buy perspective. Now, inflation rates obviously change over time in response to factors such as changes in monetary and fiscal policies, changes in currency movements, international political events, etc. So inflation obviously is not something that stays the same or is particularly easy to predict over the longer term. But just to remember that when we're looking at investment returns, they're nominal unless we account for inflation as well. Okay, so let's actually move on to bonds or debentures. They mean the same thing. They are long-term debt instruments that will be issued by governments in the case of government bonds, and corporates in the case of corporate bonds when they want to raise funds. Okay, so government or corporates or companies who will be the issuer of the bonds, they want to borrow a certain sum of money, they issue the bonds, and then investors or lenders will invest in those bonds. And in return for their money that they've handed over, the investor will receive a legal claim on future cash flows from the borrower. So it's a contractual obligation that then arises when a government or corporate issues bonds. And in this contract, the issuer promises to make regular, usually semi-annually in this country, interest payments. Now, these interest payments are called coupons, okay? And they make these payments, coupon payments, every period until the bond matures. They also promise to pay the principal. Now, it's got lots of different names, so don't get confused. It's either the principal or the nominal or the face or the par or the maturity value of the bond when it matures. Okay, so get this sort of straight in your mind. When you invest in a bond, what you are promised by the issuer is that you will receive a stream of equal coupons over a certain length of time until the bond matures. And also when the bond matures, you'll get your original face value of the bond back as well. Now, since these above promises are contractual obligations, as I mentioned, if the issuer fails to keep them, then that government body or corporate are subject to legal action on behalf of the investors. So the bond, there'll be a bond document that will be drawn up. It's a negotiable instrument, meaning that it can be traded anytime during its lifespan. So just because you invest in a bond when it's first issued doesn't mean you have to hold on to it. There's a market for these bonds at any time. So you can sell your bond and buy other bonds at any point during those bonds' lifespans. And where would you trade these bonds, or where these bonds traded? Well, it's on the JSE debt market. Formerly, it was on the Bond Exchange of South Africa, Bond Exchange of South Africa, BISA, which was subsequently rebranded to the JSE debt market. BISA was licensed in 1996, but then it became a wholly owned subsidiary of the JSE in 2009. It's got trading hours of 7 a.m. till 6 p.m. Monday to Friday. It uses automated screen trading software called Neutron. On this debt market, both bonds and over-the-counter bond options will be traded. Bond options are things like bond indices. So just as there's an all-share index, there's an all-bond index for corporate bonds and an all-gov or a gov index made up of 20 highly liquid, large market cap listed bonds that you can also invest in on this market. Now, just to give you an indication of the size of the market globally, it's about 119 trillion, or as at last year, 46 trillion in the US market alone. Over 1 trillion of bonds is listed on our JSE debt market board. These are mainly corporate bonds, but also government bonds, parastatal bonds, municipal bonds, utility bonds such as water board, and the ever popular emerging green bonds. So the JSE debt market is the largest listed debt market in Africa, both in terms of market cap, which is the number of bonds issued in the market times the bond value, and in terms of liquidity. So the ease with which they are traded or trades are made on the debt market refers to its liquidity. So you can buy and sell bonds on this market whenever you need to. More details, depending on the instrument, interest on bonds is either fixed at a fixed rate or it's floating. When it's floating, it'll generally be pegged to some sort of benchmark like inflation rate or a prime lending rate. Interest might even be zero. There are bonds called zeros. Zeros, which pay no interest. They just pay the face value of the bond back at maturity. The secondary market in government bonds is active because each loan or debt issue has specific characteristics that appeal to different investors at different times. Maybe it's the term to maturity, the length of the investment that would appeal to the investor. Maybe it's the return at the time, the fact that you sort of guaranteed your returns because it's the government that's issued them, whatever the case may be. I've already spoken about the JSE debt market being, it's actually the most liquid bond market in Africa. Government bonds, by the way, tend to be more liquid than corporate bonds. In other words, they're easier to, they buy and sell more often, quicker, in a shorter space of time. Government bonds are often considered to be a less risky investment than corporate bonds because the cash flows are virtually certain. Both corporate and government bonds are considered to be less risky than buying shares. But that then would be why they are potentially lower return than buying equities. And government bonds usually pay lower interest rates than corporate bonds. Lower risk, lower return. Typically, it'll be your large pension funds that invest in bonds. They obviously want to ensure that they've got a certain allocation of low risk investments with regular interest payments in their funds, because that's, a typical pensioner needs regular cash flows every month or whatever to live off during their retirement. Let's quickly whiz through the features of a hypothetical bond. Okay, so we just a pretend bond. So this particular issue was 100 million. So this company wanted to raise 100 million. So they issued 100 million rands worth of bonds in their own company. This was done on the 1st of Jan 2000. That's when they were first sold in the primary market. Obviously, thereafter, when the trading takes place between investors after this initial launch or issue, that would happen in the secondary market. They're going to mature in 2030. So they were 30-year bonds initially. And that is when the principal, the par value or the face value will be paid to the investor. The annual coupon is 105. So that's the annual interest that this bond will pay to bondholders. The bonds are denominated as 1,000. Okay, so each bond has a face value of 1,000 up front. And for every bond of 1,000 that the investor invested in, they're going to get 105 Rand per bond per year. So that means, if you think about it, the coupon rate, interest rate is 10.5%. Because if they're going to get 105 Rand every year on their bonds with a face value of 1,000, that's a 10.5% fixed coupon rate. The offer price is mentioned as 100%. So they're not offering them initially at less or slightly more a discount or premium to their face value. They're offering them at 100% of their 1,000 Rand face value. This yield to maturity is important. It's going to be the IYR in your calculator. When it's originally issued, this bond, so on the 1st of the 1st, 2000, that was the rate of return that an investor would have got if they'd bought the bond then and held it to maturity. They would have received a stated annual rate of return of 10.5%. Okay, but as you'll see, this yield to maturity changes with time. To continue, these coupons are going to be paid twice a year, which is pretty standard for bonds, on the 30th of June and the 31st of December each year. Okay, so these coupons, the annual coupon of 105 Rand is going to be paid out to investors in two sums of 52.50 Rand on each of these dates every year. Okay, so the annual coupon is 105, but it's going to be paid semi-annually at 52.50 Rand each time on those dates. Any security issues? Nope, the loan was not secured against the assets of the company. This call provision, if there is one, it means that the company that or government that issued the bonds have the right to call them back at a certain point in time at a certain price if they want to. Okay, so and this will be built into the bond indenture up front. This particular hypothetical bond is not callable before the 31st of December 2015. Okay, so these bonds were issued originally in 2000, and halfway through the 30-year period, the company or the corporate or the government who issued the bonds have the right to call them back. In other words, buy them back from the investors at a call price of 1,100 Rand. Okay, so what that means is after the 31st of December 2015, the company can buy back these bonds for 1,100 per bond. And whether they do so or not will depend upon prevailing interest rates at the time. They'll make a decision once that time is reached. Rating. Okay, you learned about ratings in topic 1, I believe. Bonds, just like sovereign countries, have ratings, debt rating. Standard & Poor, for example, has given this bond rating AAA, which is their highest rating, meaning they consider these bonds to have the lowest probability of default or not being able to pay those coupons or the face value to their investors. Where do you find bond prices? They'll be reported in the business day every day, where you'll see the closing yield to maturities of a few very liquid, well-traded government and parastatal bonds, as well as the bond indices like the All Bond Index. Various other websites will also provide free access to prices of bonds traded the previous day. For example, it might appear like this. The bond code, the R186. Now that's a government code. It'll start with an R. It's a government bond code issued by the South African government. Coupon rate of 10.5. It matures on the 21st of December 2026. Its yield, which will be used to calculate the ruling bond price on that day, was 9.27%. That's the yield to maturity. And then we've got two prices. Obviously, depending when you buy a bond, there might, some time will have lapsed since the last coupon payment. And you'll be buying, you'll have to compensate the seller of the bond for the days that have passed since the last coupon payment, when they would have been getting some of the interest or the coupon for the next payment. So you're going to have to compensate for that, So the all-in price, which is also called the dirty price, in this case is 110 Rand 66. The clean price, if you didn't compensate them for the accrued interest, is 108 Rand and 1 cent. And the difference between the two is the accrued interest. So the interest on the way to the next coupon period, as it will. So your all-in or dirty price of the bond per 100 Rand nominal. These bonds were issued at 100 Rand initially. Will include the accrued interest. And that's the price that an investor would pay on settlement date when they're purchasing this bond. This particular bond, with its coupon rate of 10.5, that's the annual rate. And this particular bond happens to pay coupons twice a year. So every 6 months, the bond is going to pay half of 10.5, which is 5.25% of the nominal value of the bond. This clean price, as I said before, is the dirty price excluding accrued interest. And the accrued interest is just reflecting any interest that's due if the bond is transacting between coupon dates. Okay. So this R186 is a particularly important bond. It was issued in May of 1998, and it was to raise funds for the general purpose of national government. Interest is paid on the 21st of June and the 21st of December each year. And this bond is actually used as a benchmark when we're looking at long-term bond performance in the country. So that's the significance of the R186. Let's just delve a little bit deeper into clean versus dirty prices, clean versus all-in prices. So your clean price will be your quoted price, but it excludes any accrued interest. The dirty or all-in price will be the price that you'll actually pay. It'll include any accrued interest if the transaction is taking place in between coupon dates. So if we've got a bond with an 8% coupon rate and a 1,000 Rand par value, it's being valued on the 15th of July, and its coupon dates are the 15th of November and 15th of May. So twice a year coupons, so 4%, in other words, twice a year. The clean price is 1282.50, but that doesn't include the fact that interest is accrued. We're valuing it on the 15th of July. The last coupon was paid on the 15th of May. So we're en route to the next coupon payment, which is the 15th of November. It's somewhere in between. So how many days since the last coupon? So between the 15th of May, when the last coupon was paid, and the valuation day, which is the 15th of July, there's 61 days. That's the remaining 16 days of May, plus 30 days of June, plus 15 days of July. That's where the 61 comes from. The number of days in the entire coupon period, the 6-monthly period, to be precise, you can work it out as 16 days of May, 30 of June, 31 of July, 31 of August, 30 of September, 31 of October, and 15 of November. And that's where 184 comes from. So the whole coupon period is 84 days long. 61 days have lapsed since the last coupon. So 61 over 184 days worth of interest has accrued. Okay. And the interest itself will be 4% of 1,000 multiplied by this proportion of the coupon period where interest has been accruing. And that accrued interest will then be 13.26. So we add the accrued interest to the clean price of 128,250, and that is the dirty price. Okay, so you'd actually pay the 1295.76 for this particular bond. Now, I haven't done it, but apparently you can use Excel's price, P-R-I-C-E, in capitals function to value a bond that pays periodic interest, if any of you are interested in exploring. You can actually, if you put in enough information, it can actually calculate your all-in price for you. Okay, let's go back to that bond rating that we saw. So just as countries have a sovereign investment rating, the foreign currency of sovereign governments, the foreign currency debt of sovereign governments is also often rated, and bonds are rated in turn. And firms will have to pay to get their debt rated. And essentially what they'll be paying for is someone to come in at one of the rating agencies to assess their creditworthiness as the issuer of these bonds. So how likely is it that this issuing firm will default, and what protection will lenders have in the event of default? That will determine the creditworthiness of the issuing company or government. The benefit of a debt rating is that it allows for more competitive pricing. So obviously, the more creditworthy issues with the better ratings will be afforded lower interest costs than would be the case in the absence of a rating. So this is the benefit for the issuing firm. Lower risk, lower return. You probably learned from your previous topic that the main credit rating agencies are Moody's, Standard & Poor, and Fitch's. So these agencies will derive their ratings by using financial ratio, cash flow analyses. They'll assess the likely payment of bond interest and bond principal. And as I said before, the higher the rating, the lower the risk, the lower will be the demanded return. Okay, jump up, stretch your legs, have a comfort break. We're going to move on now to how we value bonds. Okay, so we've already stressed that the value of any asset is the present value of all the future cash flows that asset is expected to provide over the relevant time period. That is equally applicable to bonds. The market value or price of a redeemable bond. Now, that's a bond with a maturity date, a set maturity date. For example, it's going to mature in 20 years' time on a certain date, whatever. That's a redeemable bond. That'll be the combination of the present value of the regular coupon payments that it promises, and that takes on the form of an annuity, which you're very familiar with, and the present value of the face value or the lump sum that's going to be repaid when the bond matures. Now, you know how to present value an annuity and you know how to present value a lump sum. So present valuing the future cash flows of a bond is going to be nothing new to you, the process behind it anyway. So bond value is the PV of the coupons plus the PV of the par value. Because when you invest in a bond, you are promised those equal periodic coupon payments until maturity. And also at maturity, along with that final coupon, you'll also get the par value of your bond back. So the coupons take on the form of an annuity, and that par value takes on the form of a lump sum, and you know how to PV those two. We taught you this earlier in the topic. Now, just remember, we're going to discount those cash flows, the coupons and the par value, at the yield to maturity, the market rate, not the coupon rate. Very important to remember. Over time, interest rates change. And although the cash flows will remain constant, those won't change. The coupons will stay the same as specified by the coupon rate. And the face value of the bond doesn't change either. They're all contractually set in the beginning. But because market rates are changing, the value of the bond is going to fluctuate, because that's the rate that we use as our yield to maturity. Just remember, present values and the interest rate are inversely related. So as interest rates increase, present values of bonds will decrease, and vice versa. Now, we can value a bond at any time along its road to maturity. So when a firm needs to be valued and its debt needs to be valued, we can value their bonds that have been issued, that are out there, by using these basics. What are our bond terms? Now, I've put in blue the inputs on your financial calculator. So you've got your par nominal face value, which will generally be indicated, it will be your FV. That's your principal amount of the bond that is repaid at its maturity. And remember, it's not necessarily equal to the market value of the bond. And just to say that unless we state otherwise, we're going to assume it's 1,000 Rand. Okay. The coupon rate is the annual coupon divided by the par value of the bond. Okay, so in the previous example, the annual coupon was 100. we put that over the par value of 1,000, the coupon rate will be 10%, the annual coupon rate. The coupon itself, which will be the PMT, the annuity amount in your calculator, these are the stated interest payments made on the bond, and that'll be the 100 Rand per year. Maturity date is the date at which the principal amount of the bond must be repaid. So it's the time to maturity from now, not from when the bonds were originally issued, from today when we're trying to assess the bond value. And that will be N in your computer. The yield to maturity, YTM or RYR on your calculator, is the rate required in the market on this bond or bonds, similar bonds in the market. So it's the rate that will be earned if the bond is purchased at its current market value and held to maturity. Or it's the interest rate earned in the marketplace by investing in bonds with a similar risk profile at that time. Okay, so it's very important that you distinguish between this coupon rate, which stays constant until maturity, and the yield to maturity, which will change as market conditions and interest rates change. Because the coupon rate and the face or par value are fixed by the bond indenture contract when it's originally issued, the expected cash flows, in other words, the coupons and that par value that you get at maturity, won't change during the life of the bond. However, the bond price will change because, as I said, interest rates change as the bond approaches maturity. This is just a diagrammatic representation of what the cash flows on a bond look like. It happened to be valued at par in 2013. Now, as at 2013, it had 10 years left to maturity. It matures in 2023. So just an example. If you'd invested in this bond in 2013, you would have got its 100 Rand coupon. So it obviously had a coupon rate of 10% and a face value of 1,000 or par value of 1,000. You'd get equal annual 100 Rand coupons for the 10 years. And as well, in the 10th year, you'd get your 1,000 Rand back, your par value back. And all we're trying to do is discount all of those cash flows back to the present, add them up, and that will give us our bond value as at time naught, which in this case was 2013. So the present value of the annuity part of this amounted to 614.50. The present value of the 1,000 amounted to 386, and the sum thereof was 1,000. So this was showing the present value of a 10-year annuity of 100 Rand at a yield to maturity of 10%. That's the 614.50 part, and then the 386 part was the present value of the 1,000 Rand lump sum. Obviously, we're going to be using our financial calculators or Excel to value bonds, but this is just an illustration of what's going on in the back room of the engines of these applications. Okay, so this bond had a par value of 1,000, coupon rate clearly of 10% because those coupons were 10% of 1,000, which is 100 Rand per annum. Okay, now there's some relationships that we need to just talk about. Firstly, the relationship between the yield to maturity and the corporate and the coupon rate. And I hope by now you realize that they're very different things. But when the coupon rate is equal to the yield to maturity, then you'll see that the market value of the bond will equal its par value. We say that it'll be trading at par. So when your coupon rate and your yield to maturity are equal, the market value of that bond will equal par. A bond which is trading below par, in other words, for less than its face value, that's known as a discount bond. In that case, it's a discount bond and trading below par because its coupon rate is less than the market rate or yield to maturity. And therefore, for the holder or investor to earn the same return, the value of the bond has to be smaller. Similarly, if a bond is trading above its par value, it's known as a premium bond. And it's thus called and trading above its par because its coupons are more than they would be currently compensated for in the market. So the coupon rate is higher than the yield to maturity at that time. And therefore, the value of the bond has increased to reflect this. Okay. So you can tell when you compare the yield to maturity and the coupon rate of a particular bond, whether its value is going to be more or less than its par value when you eventually calculate it. Let's illustrate. Okay, firstly, we're going to value a par value bond. With annual coupons. Okay. We're going to know that it's a par value bond immediately because its coupon rate is 10% and the yield to maturity is 10%. So even before we apply our techniques to value this bond, we should be able to tell based on the relationship that I set out on the previous slide that this is a par value bond. Its coupon rate and the market rate are the same. Anyway, it's got a coupon rate of 10%. Its coupons are paid annually. Its par value is 1,000, and it's got 10 years to maturity. How do we value bonds using our financial calculator? Pretty straightforward. We put our N in as 10 years. We put our IYR in. By the way, it's the yield to maturity that we're using here as 10. It's not the coupon rate. Our coupons we have to work out. If the coupon rate's 10% and the par value is 1,000, then the coupon is going to be 10% of par. That's how we work out the annual coupon. Sorry about that line that goes through there. It shouldn't be there. So 10% of 1,000 is 100. That's our payment, PMT. 1,000 is our future value, which is our face or par value that we're going to get back at the end when we invest in such a bond. And then we hit PV and it gives us 1,000. Don't worry about the sign. It's an outflow because that's what an investor would pay for it to get this positive coupon and this positive face value at the end. So that's why it comes out as a negative. There's another way that you can use your financial calculator that I'm less fond of, but some of you might prefer it. I think it's longer. You use your CFJ and your NJ and your NPV keys instead. So, you know, you've got this series of cash flows that aren't all the same. So you put in your IRR as 10%. Again, you're using the yield to maturity. 0 is your first cash flow. 100 is your next one. It's your first coupon. There are 9 of them. So you use your NJ key. Your final cash flow, which is CF2 in this context, is the 1,000 Rand that you receive at maturity, your par value, plus the last coupon of 100. Okay. And then you hit NPV and then you'll get the same answer. I'm going to show you how to use Excel later. Again, there are a couple of ways you can do it. The easiest one in most instances is this first one, where we're just present valuing the payments and then we're adding the present value of that future value or face value. Okay, so this particular bond is trading at par or 100% of its nominal value, which is 1,000 Rand. And as I said before we started, we knew that its bond value would be its face value because the coupon rate and the yield to maturity were both 10%. Incidentally, there's also a second way in which we could use Excel, but using the NPV formula, but I'll show you that on the separate Excel demonstration. Okay, so let's value a premium bond now with annual coupons. Suppose you are looking at a bond with a 10% annual coupon. Okay, so that's the coupon rate, face value 1,000, 10 years to maturity, and the yield to maturity is 8%. Now this time, the yield to maturity or the market rate on similar bonds is 8%, whereas this bond is giving you a 10% annual coupon. In this case, we will know that it's trading at a premium to its par value because the coupon rate is higher than the yield to maturity. So we know we're looking at a premium bond and that its value will be more than 1,000, which is its face value, when we work it out. So again, using the calculator, two ways. I prefer the first. You enter 10 as your N, 8 as your IYR, which is your yield to maturity, 100 is your payment. Why? Because your coupon rate is 10% and your face value is 1,000, and 10% of that will be your fixed payment that won't change. 1,000 is your face value that won't change. It's your par value that you're going to get back at maturity after 10 years, and you hit PV. Okay, you can also use two methods of Excel, which I'll show you at a later point. Now just remember, bond prices are often expressed as a percentage. So in this case, if it was, they'd say it's trading at 113.42% of its nominal value. So its nominal value is 1,000. Its current value is 1134.20. So we could say it's trading at 113.42% of its nominal value, or it's priced to yield 8% at 1,134 Rand and 20 cents. It's trading at a premium to par. So when this 10% bond was issued, bonds of a similar risk and maturity were yielding 10%, and the coupon rate was set so that the bond would sell at par at 10%. Now the bond's got 10 years left to maturity. However, bonds of a similar risk and maturity are being issued to yield 8%. So they have coupons of 80 Rand a year. This bond we're looking at pays 100 Rand a year. Consequently, it's going to sell for more than its 1,000 par value. Mathematically, as yield to maturity decreases, bond value increases. However, you can intuitively grasp that you'd be willing to pay more for a bond that pays 100 Rand per year for 10 more years than you would for a bond that pays only 80 Rand per year for 10 years. So investors will be willing to pay a premium more than par to get the extra coupon, like in a bond like this one. Okay. Let's value a discount bond with annual coupons. So here we've got a bond with a coupon rate of 10%, coupons paid annually, par value 1,000, 10 years to maturity, but the yield to maturity is 12%. Okay, so the yield to maturity is higher than the coupon rate, and therefore we know we're looking at a discount bond. And before we even calculate its value, you will know that its value is going to be less than its par value of 1,000. $10 is our N, 12 is our IYR, 100 is our payment, 1,000 is our FV, our PV predictably is 887 Rand. Whichever method we use. So in this case, The bond is trading at 88.7% of its nominal value. In other words, 887. Or we could say it's priced to yield 12% at 887. It's trading at a discount to par. Again, when this 10% bond was issued, bonds of a similar risk and maturity were yielding 10%. So that's why the coupon rate was set so that the bond would sell at its par value. So the coupons were set at 100 Rand a year. Now, with 10 years remaining to maturity, bonds of a similar risk and maturity are being issued to yield 12%. So they'd have coupons of 120 Rand a year. But this bond's only paying 100 Rand a year. Consequently, this bond needs to sell for less than 1,000 Rand. You wouldn't be willing to pay as much for a bond that only pays 100 Rand a year for 10 years as you would for a bond that's paying 120 Rand per year for 10 years. So you'd only pay 887 Rand for this particular bond. It's priced to yield 12% at 887 Rand. Okay. Here are a couple of bond pricing, well, 4 bond pricing theorems that are always true. Bond prices and market interest rates move in the opposite direction. We know this from time value of money times. Secondly, when a bond's coupon rate, and this is what we've just showed, is greater than the market's required return, the bond's market value will be greater than its par value. When the coupon rate is equal to the market's required return, or yield to maturity, the bond's market value will be equal to its par value. And when a bond's coupon rate is less than the market's required return, then the bond's market value will be less than its par value. Okay, we've just illustrated this. The risk that arises for investors in bonds from fluctuating interest rates is called interest rate risk. How much interest rate risk a bond has will depend upon how sensitive its price or value is to interest rate changes. That sensitivity is determined by 2 things, and that's what theorems 3 and 4 refer to. The first being the time to maturity, and the second being the size of the coupon or the coupon rate. And theorem 3 says that given 2 bonds identical, but for their maturity, the price of the longer-term bond will change more than that of the shorter-term bond for a given change in market interest rates. Because a bond's, or a large portion of a bond's value comes from its face value at maturity, and its discounted value becomes very small when the maturity date is very far into the future. That's straight time value of money logic. So if a shorter term bond like only got 1 year left to run, the present value of its par value will not be as greatly affected by a change in interest rates as a longer bond with say 10 years to go. Okay. So time to maturity will affect interest rate risk and therefore bond value. The fourth and last theorem is that given 2 bonds identical but for the coupon size, the price of the lower coupon bond will change more than that of the higher coupon bond for a given change in market interest rates. The value of a lower coupon bond is proportionately more dependent on its par value to be received at maturity because it's got low coupons, and hence the same reasoning as I provided for theorem 3. Basically, a bond with a larger coupon has larger cash flows early in its life, so its value will be less dependent upon its face value to be received at maturity. Hence, its value is less sensitive to changes in the discount rate. Okay, so bond prices and market interest rates move in opposite directions. That's bond prices and the yield to maturity. When a bond's coupon rate is greater than, equal to, or less than the market's required return, the bond's market value will be greater than, equal to, or less than its par value. Interest rate risk arises when you invest in a bond. That's the risk from fluctuating interest rates, which will have effect on the bond value. How much interest rate risk a bond has will depend upon how sensitive its price or value is to interest rate changes. And that sensitivity is determined by two things: the time to maturity, as indicated in Theorem 3, and the size of the coupon, as indicated in Theorem 4. Okay, so up until now, we're dealing with when coupons are annual. What about when they're semi-annual? In practice, they will be they're expressed. Your yield to maturity and your coupon rate are expressed in annual terms, but the coupons might be paid more frequently than annually. So your bond yields will be quoted like nominal annual rates, or APRs. The quoted rate is equal to the actual rate per period multiplied by the number of periods. And in South Africa, it's common practice to pay coupons twice a year. So if the coupon rate is 10%, that's annual. But with semi-annual coupons, then the holder of the bond with a par value of 1,000 will receive 2 payments of 50 Rand. Now, how does this affect the valuation of the bond? Okay, it's exactly like when our payments were semi-annual or quarterly or whatever the case before in the first part of this topic. So when the payment of the coupons is semi-annual, you'll have to divide your coupon rate by 2 to get your coupon. You'll also have to divide your yield to maturity by 2, and you'll have to multiply by your N by 2. If it's quarterly, coupon rate divided by 4 to calculate your coupon, yield to maturity divided by 4, N, years to maturity, multiply by 4. So let's find the price of a bond with a coupon rate of 14% paid semi-annually, with a yield to maturity of 16% and maturity in 5 years' time. So nothing's changed. I always said everything hinges off your payments. In this case, it's your coupons. They're semi-annual. So we've got to work out the size of a semi-annual coupon. We'll be dividing this 14% rate by 2. The yield to maturity, the annual rate of 16 becomes a 6-monthly rate of 8%. And this maturity in 5 years' time becomes 10. We multiply by 2. I also want you to note here that the yield to maturity in this example of 16% is greater than the coupon rate. So we'll know that this bond is trading at a discount to its par value. And that's proved when we value this bond. 70 is our payment, because that's our annual coupon. It will be 7% of 1,000 every 6 months. 10 is our N, it's 5 years times 2. 8 is our RYR, it's 16% divided by 2. 1,000 is our FV, and our payment, our PV is 932.90. Okay. All the while, your PYR setting, by the way, is remaining on 1 at this point. You could also, as we've done in the past, put your PYR setting on 2, and then you put your annual yield to maturity in as 16 as your RYR, and it'll divide it by 2 for you. Okay, how do we work out the yield to maturity? Remember, that's the rate that's implied by the current bond price. It's very tricky without a financial calculator or Excel. It involves a lot of trial and error, and it's extremely time consuming. Easy with the financial calculator. We're going to enter our N, our PV, our payment, and our FV in the normal course, and we're going to solve for our R. So the PV will be the current bond price. N is still our time to maturity. The payment is the coupon, and FV is the face value to be received at maturity. Just remember our sign convention from before. Payment and FV are normally both inflows, and PV is an outflow. Using Excel, it's a little bit trickier. You have to set out all your cash flows of the bond, and then you're going to use your IRR function. Okay, internal rate of return. And in brackets, you're going to put the cell address for your year naught cash flow, a colon, and then your cash flow at maturity. And it'll work out the internal rate of return based on that stream of cash flows. That final cash flow at maturity obviously has to be the final coupon as well as the face value. And your year naught cash flow is going to be your current bond value, which will be an outflow. Your current bond price. Okay, so here's an example. We've got a bond with a 10% coupon rate, semi-annual coupons, face value of 1,000, 20 years to maturity, and it's selling for R1,256.50. So immediately we can see that it's a premium bond. It's trading at more than its par value. Therefore, we know that the coupon rate of 10% must be more than the yield to maturity that we're going to be solving for. Okay, so we use our financial calculator. 40 is our N. Okay, it's got 20 years to maturity, but the coupons are semi-annual. So we multiply our 20 by 2. Our current price of the bond is 125,650. Remember, it's a negative because it's an outflow. You'd have to buy it for that. 1,000 is our FV, and 50 is our payment, which we get by dividing our coupon rate by 2. 5% of 1,000 is 50. Or you can work out your annual coupon, which is 10% of 1,000 of 100 Rand, and divide that by 2. And we solve for our R, but remember, that's going to give us a semi-annual yield, and we have to double it to get it to the yield to maturity, which is always annual. And as predicted, it's less than our coupon rate. We knew that because the bond was selling at a premium to par. Or you can get straight to the yield to maturity as an annual percent. If you put your PYR setting on 2, still put 40 in as your N, same PV, same FV, same payment. But then when you hit IRR, it'll already give you your annual 7.5%. Okay, using Excel, this is a very lengthy process because there are actually 40 periods to go, 40 coupons in other words, which are all going to have to be entered. So Excel's not always very functional when you have a long time to maturity. Lastly, how do we value non-redeemable bonds or debentures? By non-redeemable, we mean they're not redeemed at some fixed time in the future. They don't have a set maturity date. In other words, they're perpetual. There are debentures in perpetuity. They have no redemption date. And we know how to present value at perpetuity. We take the perpetual cash flow, which in this case will be the 15 Rand coupon, because it's got a face value of 100. It's got a coupon rate of 15% per annum. So the annual coupon is going to be 15% of 100, which is 15 Rand. And we divide that by the required return of 9% as a decimal. And the value of this debenture, or bond is 166 Rand and 67. Okay, so that comes to to the end of this recording on interest rates and bond valuations, and we'll commence with the next recording, which will be all about share valuations. Take care, and until next time.